Welcome to Darin Batchelder's Real Estate Investing Show. Each week, you will learn how to grow your wealth through real estate investing. Be introduced to the players that are getting it done and learn how you can get involved. And now, here's your host, Darin Batchelder.
Hello, everyone. Today we have a very special guest. We've got Jonathan Nichols. Jonathan, appreciate you coming on the show.
Thanks for having me, Darin. Excited to be here.
Absolutely, another DFW guy. So I'm located up in Prosper, and you're in DFW, so that's fantastic. So just a little bit on how we know each other. This is the first time we're actually talking together. But I know of Jonathan he's been on a number of different podcasts, and he's in social media, and he's in the multifamily space. So with all of that, I wanted to get a better understanding as to what he's been up to. So before we get started, can you share with the listeners how many properties and how many units you're invested in?
Yeah, absolutely. So like you said, Darin, I'm a multifamily syndicator here in the DFW Metroplex. My wife and I, we started out in real estate 5 years ago investing in residential short-term rental properties. So we have 19 of those that we still own and operate. And then on the multifamily side, we're general partners in a little over 400 units, and then limited partners, I don't remember exactly, but well over 1,000. So that's kind of our experience level. Pretty much everything here in Texas or in Oklahoma for markets.
Fantastic. So I read your background, and you come from a aerospace engineering background. So how does that you were in that space for, confirmed, I think 10 years, and confirm how, having that experience helped you moving into the multifamily space. And then, I know a few folks that also have come over from that space, so I don't know if you know them. Dustin Miles, he's from
I do know Dustin.
Multifamily.
I do know Dustin. Absolutely.
So he was an aerospace engineer, and also Alex and Sarah May out of Colorado.
Okay, don't think I've had the pleasure to meet them, but I'll have to look them up.
Fantastic. So share kind of how that experience helps you in your role as an investor.
It's interesting because I have a lot of people that ask me, like, why would you leave an aerospace engineering job to go be a real estate investor? And so it's something that I've spent a lot of time thinking about. And for me, I think it goes back to how I became an aerospace engineer. And that was, I was 8 years old in my living room as a kid, and I was watching the movie Apollo 13. And I was fascinated by all these guys in the command room that were, calculating these orbits and trajectories and all this. And it was something that it looked so complicated, but yet so meaningful. And I think that's really what attracted me to aerospace as an industry. And when I was a student in school, I loved what I studied. I worked incredibly hard at it, really enjoyed it. So much so that even after I graduated and started working full time, I actually pursued my master's degree part-time because I just wanted to keep learning more. So that's the cool part of the story. The not so cool part is that, oftentimes in the corporate world, you kind of get pigeonholed into one little avenue. And, your career, your life is not necessarily like a movie, right? So I found myself, after having been in the aerospace industry for several years, kind of being pigeonholed into more project manager roles, or if I was doing technical, just one little specific area and nothing else. And I started to get bored. And so it was about that same time that my wife and I began investing in real estate, and that business continued to grow and grow. And I felt that sense of challenge in real estate, in investing, that I had, kind of sought in the world of aerospace. And so that's one thing I really enjoy about this industry is it's not easy. It's, especially being an active investor is not for everyone. And so I really enjoy the challenge on it. And I think the cognitive skills, the logical reasoning, the ability to handle stress and make decisions quickly are all things that I learned in the world of aerospace engineering that, now I utilize as an investor.
That's awesome. I love that. So first of all, you said learning. You were talking about learning. I love the fact that, as young people, you go to school and you're forced to learn whatever you're being taught, and then you get out and you go to college and then you become an engineer, and engineering, is big on problem solving and how to come up with solutions. But then I've talked to a number of engineers, and like you said, that you get pigeonholed. There's some engineers that they have, their mindset that they're going to do these amazing engineering feats, but then they're working on something really, really small.
Yeah.
And so that that boredom, that challenge is kind of what it sounds like has really prompted you to go off on your own.
Yeah, and it's interesting you say that. I think now, being an entrepreneur, being a business owner myself, I kind of understand the situation a lot better. But if you think about it in the business world, it's all about systems and processes, right? Like that's how you make an efficient business that will generate a profit. But what that means down on the individual level is it's almost like they need individual cogs in the machine, right? And so they teach you how to do this one specific part and put you there. And that's your purpose in the company, is to keep that particular part of the wheel turning. So, it's great from a business efficiency standpoint, but, if you want to challenge engineers and, keep them on their toes, may not be the best solution. So at least that's what I found in my case.
I get it. So you graduated from Texas A&M. My son just graduated from Texas A&M. So,
whoop.
Congrats on that, right? So when I looked at your background, your first, what I would say larger deal, 75 unit complex was down in College Station. So why did you pick that? And was that student housing or was that traditional multifamily?
Yeah, all great questions. So that was our first deal we did as lead sponsors. We had co-GP'd a couple deals before that.
Okay.
But yeah, that was our first deal as the lead sponsors on a large syndication project. And it was a market that I was very familiar with, but wasn't particularly necessarily focused on. But that deal was brought to me off market through a broker relationship that I had. And said broker does not live in College Station. And so when he thought of A&M, College Station deal there, he thought of me. And so he bought the deal to me, and it's a very new deal. It's 2012 build, which not your typical syndication type of property. And so the value add component, what drove the returns on that deal was implementing professional management. It was owned by a mom and pop. They basically just cared about keeping it 100% occupied and low drama all the time, which usually results in, having rents well below market. And so we took it over, required almost nothing from a CapEx budget perspective.
Wow.
And then, year one, we were able to push the average rents, I think $125. And this year we're up like another 40 or 50 beyond that. So that project's been fantastic. Plus it's just a newer property that doesn't have as many issues as, what you'll see in an older one. As far as student housing, it's located a half a mile from the campus, so we do have students who live there. One of the challenges I actually faced on that deal was the lending, and getting lenders to look at a project that had a certain amount of students. And so at the time I bought it, I think it was about 60%. And even though they're year-long leases and we're renting by the unit and not by the bed, it basically the lenders were not super happy with it, and they said we want it below 40%. So part of our business plan now is we're pushing that student population down just a little bit to get below that 40% mark, so that when we go sell it, our buyer will be able to get an agency loan and therefore, pay us a lot more for the property. So.
Yeah, that's interesting. So it's not just pushing and maximizing the NOI, but it's also positioning it for a sale to somebody else, and how it's going to be perceived and from their lenders.
Absolutely. And it's something you see that in the multifamily world all the time, especially right now. You have a lot of projects on bridge loans where they're 80% occupied, 85% occupied, and they're working hard to get to that 90% hurdle so then they can sell the deal to a potential buyer, and allow them to get an agency loan, and therefore commanding a much higher price. And so it's actually something you see quite a lot. I would say the the student to non-student strategy has been a little bit unique to our project, but it's been very easy to do, just considering the location and demographic that our property attracts.
Yeah. So talk about having to, like on a traditional multifamily, you're going to have turnover, say every month, right? And it's more evenly dispersed throughout the year. But with something that has 60% students, all those students are turning over at the same time,
That's
right
correct.
before the new school year. So talk about the challenge that you have just from, doing those turns in that short period of time.
Yeah, so it's an important question that anyone buying, and I don't really consider myself a student housing person. I'm a multifamily owner that just happens to have students in my property, right? But the question's still pertinent. The first and most important thing is your property manager. And so, if you're just buying a multifamily property in general, if you're an experienced operator, you recognize you need a property management company that fits the profile of your property. So, think things like location and size. Some property management companies only do 100 plus units. Others, they only do smaller properties, and their payroll and how they do things is their systems are set up for that type of property. So it's the same thing in the student housing world. And the most challenging part, as you mentioned, being the turns. It goes to several things. It's you kind of play defense first. One way we're doing that is by, on our property is reducing the student population some. But then beyond that, it's really looking for those renewals, right? So if there's a student who, we're leasing by the year, so they know up front they're okay with staying there through the summer. If there's a student who's continuing to study, we're giving them very fair renewal rates. We're, asking for that renewal commitment very early on, as in like February, March timeframe. Stuff like that to encourage as many renewals as we can get. And then beyond that, it's really identifying when do people want to move into the property, which is obviously August, because that's when students are coming in for school. And so, we set the leases to be July ending so that, it minimizes that vacancy time. And then after that, it's just really making sure your property manager has a good schedule for the turns, that they're walking through the units ahead of time. They know what they need. Basically just that they're organized like every manager should be, but especially so because they're going to have, let's say a couple dozen turns on this property in July, as opposed to like the normal, 2 turns you might see in a month on a property this size.
Right. Two things I don't have any student housing type of properties, but two things that, I did pay the rent for my son, and I'm paying for my daughter now. She's down in Florida. But, two things I really like about how that's situated is that, from an ownership perspective, is one you touched on with renewals. Like, my son would move in, and then it was like 2 or 3 months later, like, hey, we need to renew, or there's this like scarcity feel, like, or I might not have a spot.
Yeah.
And so they're going to the parents, right? And so then I don't want my son to be without housing, and so I imagine you get a lot of renewals early, which gives you a lot of comfort that that you've got a lot of people that are coming back in, and you don't have to do the turns on those. And then second, with student housing, like all of at least for me, I had to guarantee the lease.
Absolutely.
So, it's not just the tenant, it's the parent that is also on the hook for that lease. So from a credit perspective, that's pretty strong.
Yeah, it is. And that it kind of circles back to our conversation a minute ago with lenders. We had to provide evidence to the lender that all the students had co-signers on their leases. And that's really the issue when it comes to student housing that's by the year and not by the bed that lenders will have. It's not actually having a student in the property. It's the necessity of a co-signer, right? because you're one person removed away from that lease. And so, yeah, I think it's something you got to be cognizant of if you're gonna rent to students, that you should be looking for those co-signers. Don't leave it off, because it'll greatly hurt you if you try to go sell the property. Not to mention, of course, the potential risk of someone leaving and not being able to recuperate rent or damages.
Right, absolutely. So why do the lenders feel like it's riskier, and why do they not want that? I mean, when I think of like BC properties, the income profile for the tenant is significantly lower, most likely, than the parents of the students that are attending these universities. So why do the lenders perceive more risk?
So you kind of touched on it, but it's really all about income, right? The student has no income. And
Right.
So if you think about a C-class tenant is going to have a lower income than an A-class tenant, which makes them higher risk, that then means that a student who has zero income is extremely high risk, particularly without a cosigner. But I think the reason was willing to do that on this project, at least, was what you alluded to, that all the parents, our properties, it's luxury housing. It's 2012 build. Like, I did not live in this property when I went to school.
Right.
Let's just put it that way. So all the parents of the students that live there, they're attorneys, they're doctors, they're engineers. They're people with very strong incomes who care about their financial report and their credit score and stuff. And so, for me personally, regardless of how the lenders feel, that's what gives me comfort about running a business like this.
Yeah, absolutely. I agree wholeheartedly with that. So, I know you're not a student housing guy. So, Tulsa, Oklahoma. Why Oklahoma?
It's a great question. So our company, Apogee, we invest both. We live in Texas, but we invest also in Oklahoma. And all our active projects to date have been in Tulsa. Tulsa has some great market metrics when you look at job growth, population growth, income. For example, we recently closed on a deal in Tulsa, 100-unit deal, loan assumption at 3.5%, 70% leveraged. And the median income around that property is $95,000 within a 3-mile radius.
Is it really?
That's outstanding here in Dallas,
Right.
There, it's almost unheard of. And so, I say that to you and you're almost shocked that even exists,
I am.
right?
Right.
And so, but as an investor, I can go buy something here in Dallas, which that's still going to be a really nice part, and pay an extremely low cap rate for it, and it's not going to cash flow. Or I can go up to Tulsa and buy the same property, same income profile there, and it cash flows 7% from day one for investors, So to me, to be unwilling to tap into that market's potential, I don't know. I don't see the downside to it, especially when it's flexible exit on your loan and all that. So I was born in Oklahoma. I'm from Oklahoma City. That's where my most of my family lives. So I'm very familiar with the state. I'm very familiar with the market. We love buying in Texas. It's a great appreciation type market. But if you want to get some cash flow properties in your portfolio, Oklahoma, in my opinion, it's not a bad choice.
Yeah, so I have not invested in Oklahoma, but talking to a lot of syndicators, I've had kind of two different parties. Some parties, especially when they're getting into the multifamily space, Dallas is really competitive, so they find themselves, having a hard time winning their first deal, so they go to Oklahoma, and they're buying at a cheaper basis per unit. It's not as expensive. The capital raise is lower, so it makes it easier, one, to win a deal, two, to raise capital for the deal, etc. But I've had some syndicators come back and say that was not what I was looking for, because they bought in an area that didn't have the income growth, didn't have the job growth, and they found it very hard to keep their occupancy up and to push rents. And so knowing, I would imagine that, and then I've got another group of people that have gone to Oklahoma that have done very well. And it sounds like you fit into that camp. It sounds like it's very focused on the submarket. You have to really know what you're doing and buy in the right place.
I think there's kind of two common mistakes I see in operators who go buy in Oklahoma and are unsuccessful. One is location. So like I said, I was born in Oklahoma City. My family lives there. I like the city. There is more than 50% of Oklahoma City that I will not touch. Like, it doesn't have good income statistics. There is crime. That particular submarket does not have an upward trajectory. Like, I'm not interested in it. And so, I see operators go buy there because you can get such a cheap price per door.
But there's a reason for it.
But there's a reason for it, exactly. I think that's enough said there. The other common mistake I see is people underwriting Oklahoma assets like Texas assets. And the two biggest things you'll get hung up on is rent growth and cap rate. Oklahoma does not have the cap rates that we have here in Texas. Just a ballpark, like, good area of Dallas, good area of Oklahoma, you're probably seeing 100 basis point difference on cap rates. And so you have to underwrite that correctly, because that's one of the biggest differentiators in your ultimate returns on your analysis, right? And the second thing is rent growth. Texas consistently has strong rent growth. You can underwrite, forget about the last 2 years in COVID and all that, you can pretty consistently write 3% a year here in Texas and be very comfortable with that, You can't do that in Oklahoma. It's not as strong. It's not a guarantee. And so I think, operators who are already underwriting deals sporty here in Dallas, they go there and underwrite it the same. Maybe they get in a bad neighborhood, and then the rest is history. So that's the two things I would look out for.
No, that's great. So what is the rent growth assumptions in underwriting for Oklahoma?
Yeah, I think like a good area with the 95K I mentioned, probably a couple percent per year. So my underwriting, one of my rules is I never do rent growth year one. Like, it's just the rents that you have first day is what you're going to get that year. But then after that, I'd probably do 2% in a good area. I don't really buy in bad areas, but let's just say it was a slightly less attractive area than 95K average income.
Right.
If I felt good about the economy for the next couple of years, I may do 2% and then back it off to 1.5 or 1 or something. If I felt bad, I may do like 1.5%. But probably the most important thing, in addition to just underwriting the rent growth correctly, is looking at like, what is the opportunity to force appreciation on the property, right? So if today I buy a property and it's $200 below market rent, and I feel very confident in that, I know that I've got that in the bag, right? Like, I know I can make that happen regardless of what rent growth does in the future. And so, at that point, it's like, okay, 1.5 to, even if you underwrite at 2.5, 3%, like, you're going to be okay. You may not get the returns you're expecting, but you're still going to be okay. So I would say not banking on that for your returns is probably a big deal.
Yeah. So for the listener's perspective, what Jonathan's talking about, income in the area is, when I was first doing my first syndication deal, I was going after deals that were like, in the Dallas market, probably 30 to 40,000 median household income. A lot of them were, and then I had a broker show a deal to me that I ended up buying. That he's like, Darin, do you realize that median household income here is 60,000? And I thought that was great. So when I hear 95,000 in Oklahoma, I'm like, holy cow! Because that's telling you how much money they have to put towards their rent.
Yes.
How stretched are they? The other thing that you talked about was what's the opportunity to force appreciation? I have some people that will, straight out come out and be like, what's the cap rate? And I'm like, I don't always look at that as being my first question, because you could buy, a 6% cap rate and then you can't do anything to the property and it's just going to be a 6% return,
right?
Going forward, versus buy a 4% cap rate, but then, it's $200 or $300 below market. The units are all classic units. The exterior, if you put paint on it, is going to attract a better tenant profile. All those things give you the ability to, maybe move that 4% to a 7%. And like you don't know. So you have to look at both opportunities as a complete opportunity.
Completely agree.
Hey, this I found very interesting, and I want to get your take on it. I know it's small. It was an 8 unit in Arlington. Yeah. Okay. But if I read it right, you converted all 8 units to short-term rentals. And that I find interesting from a number of accounts. One, most people think of short-term rentals as being either high-rise or single-family homes. So converting apartments to short-term rental, I'm curious as to, how that went and what the profitability differential was for that. And then 2, because you have that experience, have you looked at any of your larger deals, like 100 unit plus, and maybe you take 1 or 2 or 3 units and turn it into short term?
All great questions. It's a lot to unpack. So I mentioned, I think at the beginning of the podcast, my wife Paula and I, we started out in the investing world doing short-term rental. We bought residential properties, so think fourplex, single family, duplex, that kind of stuff, and we turned them into short-term rentals in this specific neighborhood. So we live in Arlington. It's home of the Cowboys Stadium and the baseball, the Rangers, Six Flags, all that stuff. So there's a lot of tourism in our city. But then beyond that, there's also a lot of business travelers. We're right next door to University of Texas at Arlington, which is actually one of the largest universities in the state of Texas. And so there's all kinds of traffic that anyone who would go to a hotel would also be a potential person for a short-term rental. So we have the traffic, and we have kind of proven out that business model worked well for us and had the systems in place for it. And so I kind of had this idea, I'm a visionary. I like to think of ideas, dream up ideas. It's what being an entrepreneur is about. So I had this idea a few years ago of like, hey, what if you combine the cash flow potential of a short-term rental project with the value add forced appreciation of a multifamily project, right? And like, where would that go? And so, I can go make $1 million a year on my little single family house. It does not change the value of that house. But if you do it on a multifamily and your NOI goes through the roof, in theory, like you've raised the value of that multifamily property drastically, right? And there's all kinds of debate, because I'm not the only one who's done this now, about like how that changes the cap rate and stuff. And that's probably another conversation for another day. But a broker called me one day. He's like, look, Jonathan, we have this 8 unit. It's right down the street from all your other properties. It's a dump. Like, it's falling apart. It's not just like Section 8 housing. It's like people who are not paying rent, not taking care of it. It's bad. Do you have any interest in it? And so I was like, well, I'm not a low income housing expert. I don't do that. That's outside my swim lane. But I'd be interested in, making a short-term rental out of it. And I went and looked at it, and I mean, it was rough. Yeah, it was really rough. And so I didn't feel comfortable syndicating a project like that in my mind. I knew it was going to work out right, but I just felt like the risk profile was too high to bring in an average investor on. But I have a lot of friends in this business. So I called up a few of them. I said, look, guys, this may be crazy, but like, this is what I want to do. Would you guys like to JV this deal with me? And literally I had multiple people. Yep, I want to do it. I want to do it. I want to do it. I was like, okay, we're going to do it. So we purchased the property, got under contract. And the leases came up over like, let's say a 3 or 4 month time frame. it was awful. I mean, people not paying, trashing the place. We had one guy who left a week early and just like unplugged the fridge with a bunch of meat in it and then turned off the AC and left the unit. Like, I mean, just the worst stories you can ever imagine. But we worked our butts off. We had a great team. We got every single one of the 8 units renovated and up online, permitted with the city. You have to permit here for short-term rental and up and running. And we're now nearing our second year of like 15+% cash flow every year on that deal. So it's been an awesome deal, you know, but it was a lot of work up front. And then, you know, we're still waiting on the final piece of it, which is what will it sell for one day when we go to sell it. And we're not really in a hurry to sell it because it's cash flowing at 15%. But when we go sell it, you know, it's like, what are we going to be able to sell it for? And, you know, I'm hoping for like double what we pay, but we'll see.
Awesome.
So that's the heart of it. I think you had one more question there, and it was pertaining to large multifamily.
Yeah. Right. Have you done it?
I have not. Usually with large multifamily, your ideal lender is agency debt. And agency debt does not like short-term rental on their properties. And to the extent that, like, I think I could be a little off on this, but you're not allowed to have more than, let's say, 5% or 10% of your property is short-term rentals. And the ones that you do have, they don't count towards the income on your property, both from a sense of like when you're acquiring the property, as you're trying to meet DSCR requirements, and when you go to sell the property. So it's really a huge hindrance. Now, people still do it. So it's not impossible. There are people that do it. And in fact, there was a large multifamily property here in Arlington that several people tried to do it with. And it kept falling out of contract. But I would get a call from like each one of these operators because they knew I did it down the street with some of the smaller stuff. But ultimately they wanted, you know, way too much for the property. It didn't make any sense. And the rents, the short-term rental rents that they were projecting on this were nowhere near accurate. They were much higher than what they were really getting. So I saved a few people from burning themselves on that deal. But so people have definitely thought about it. I have not done it, and those are the reasons why.
That's interesting. So I didn't realize that they would actually pull that income out of the NOI, because you think that you would get stronger NOI, but if you have to pull it out, then that doesn't help. You know, I kind of think of it as like the next step from, I've heard people do like corporate housing, where, you know, they may end up renting one or multiple units that are furnished to corporation, and they charge them, you know, a significant, you know, upcharge for having the ability to swap in different employees. Sounds like from what you're saying, the agencies would be more favorable to that than having short-term rentals.
So what agency wants to see is that, as I understand it, you have a long-term lease from a single individual on your rent roll. And so, you know, there's kind of two ways you can actually go with this business. One is you buy the property and then you short-term rental the units yourself, right? Which definitely does not meet that requirement. The second one that I think some people have tried to do and gotten a little sticky on is you rent it to someone who's doing short-term rental at a premium, right? So like say my market rent's $1,000 and I can rent it on short-term rental for $2,000. Well, maybe I rent it to another operator for $1,250, right? So I get a $250 difference. They're still paying utilities. They're still running the short-term rental business. I'm just getting a $250 difference. So that's kind of like the two approaches that I see from people a lot. I've only done the first approach. I don't really rent to other people doing short-term rental. But those are the two approaches. And so the thing was, well, okay, if I have a lease with this person, then, you know, what's the problem there? And I think that's where it gets sticky, because maybe sometimes depending on the specific lender, specific loan product, you can kind of slide it under the rug. But ultimately, that person does not have a guarantee of income, right? Like, it's not their income that's sort of floating that unit. And usually they have multiple units. So like if they have 5 units and then COVID hits and they need to pay $6,000 of rent next month, where does that come from? You know,
they're just walking away and saying, sorry, I can't do it.
Exactly. And you know, the credit penalty for walking away from 5 units is probably no different than 1 unit. So, you know, it's not a lot of skin off their back.
Right.
So I think that's the big issue. I'm not as familiar with the corporate world, to be honest with you. So I don't know how that's counted or not counted. Like if you had we live, like American Airlines is down the street from us. If American Airlines rents one of my units and just says, we're going to pay for it year round and just have employees come and go, I don't know how that works. I'm not an expert on that, but that could be a potential workaround. I don't know.
I have had syndicators say that they've had units like that and they've received significant increases in rent for doing that. But I don't know how that's perceived from the lender. So learning lessons, what kind of, you know, when I say that, typically something pops in your head, like a troubling situation that you weren't expecting, and how you dealt with it.
Yeah. So I'll just make something up here and then you tell me if I'm getting off course. I think there's a few learning lessons that I've learned. I'll give 3 here if that's okay. I'll make them quick. So one is for people that are brand new and like they want to be an active investor. And when I started out at this, because I'd been successful in the residential world, I thought I was going to do everything by myself. And so I went along as a new multifamily investor who didn't own any multifamily, but was trying to, and just thinking, hey, I'm going to find the deal. I'm going to raise the money. I'm going to do the asset. I'm going to do everything. The truth is, most of the time, syndication is done in a team environment. And I'm talking specifically on the general partnership side. And so if you're a new investor looking to get into the multifamily space, one of the best things you can do is understand your skill sets and your value that you can bring to a team, and then look for people who have complementary skill sets who you know, like, and trust that can be partners on deals. And then you're likely to find your first deal, your second deal, and really take off a lot faster. So that's one lesson learned, one thing I did wrong. It's hard to come up with one lesson for, you know, being an active sponsor because there's just so many. I learn things all the time, honestly. But I think one big thing is just pay attention to detail. Like anytime that there's a mistake that I've made or I've seen people make, it usually comes down to just not fully understanding a situation. And in this industry, there's so many balls in the air at once that it can be easy to miss something. But missing something can be really costly. And so whether it's reviewing, you know, lender documents, insurance documents, you know, partnership agreements, take the time to really understand everything and make sure you're a master at it so you don't, you know, bite off something that you didn't want. And then the last one this is one I definitely want to give is for passive investors. So I invested passively before I invested actively. And I've made a lot of different passive investments. Most of them are doing fine, but you know, I have one in particular that's been kind of a negative experience, and I've learned probably more from that deal than even any of my active deals. And I would say that one is like really know the sponsorship team that you're investing with. Like, what is each person's role? What is their responsibility? What is their track record? There's a lot of people who are on social media, just like myself. I'm on social media, but they seem like they're really good, but maybe they're not as good as they let on. And so really take the time to learn about people, build up trust with people over time, understand their track record before you invest as a limited partner in someone else's deal. That would be my advice.
I think all those learning lessons are great. You know, the first one, you know, for new people, you know, there's some people that they're like, what value do I provide? You know, and I think that in this world, and you correct me if I'm wrong, but there's a little bit of speed dating that happens, you know, when you go out and network, when you're trying to figure out, you know, who's got complementary skill sets and how you team up with other people. You know, look, if you say, here's my value, there's some people that are like, yeah, I got that covered. No, you know, I don't need that. And then they're like on to the next person. Well, if you're somebody that can't take that, you know, and just let it roll off your back and go to the next person, that's that's going to be difficult for you because it's not personal. They just have that piece covered. Now you go to the next person, next person, next person, and then all of a sudden you get somebody who's like, holy cow, you're exactly who I'm looking for.
Yeah.
Like I love doing this other piece and you love doing that piece. You know, so you have to be willing to get the no's to get to that right person.
100%. And I don't know if I mentioned this, but when I started Multifamily, Paul and I, we went through a mentorship program, like, you know, a lot of people do when they get started. And we're now actually both coaches in that program. So I talk to a lot of new investors and, you know, hear stories and give advice, all that fun stuff. I really enjoy it. And so students bring that up all the time. And sometimes the hard conversation I have to have with them is you may not be able to bring any value today. Like, you may literally not have the skill sets to underwrite. You may not have the network to capital raise. And what you need to do is just decide which one am I going to go work on so that 3, 4, 5 months from now, I do have that value. So I think that's kind of a mistake is everyone's like, oh, you have value somewhere. Of course you do. You're a person. You have value, just maybe not in a deal right now, right? So, you know, you need to figure out if you don't have something today, what is it that you're going to work to build and have 3, 4, 5, 6 months in the future?
That's a great point. I mean, you know, if I take that to, let's just say a young guy in their 20s, I could picture some people I've talked to, and they're like, yeah, but I don't, like, all my friends are, you know, in their 20s, they don't make a lot of money. Mm-hmm. And I'm like, well, go talk to your dad and your dad's friends and people that you're friends with, your aunt and uncle and their network. But that's going to take time to build that. And then don't sell just yourself, but sell your team. You know,
absolutely.
You know, you're going to be bringing on this property management company that manages, you know, 5,000 units in the market, or this attorney, or, you know, you're partnering with this guy who has, you know, he's done 10 deals. And so now all of a sudden that, you know, the older generation that has the funds, they start looking at, okay, well, you know, I trust you as a person, as a character. I just didn't know that you know, were aligned with all these other people that have the experience.
Right. Very well said. Couldn't say better.
So talk about family. You and your wife are, you know, partnered up, went through the mentorship program. Paula is your wife. You know, talk about working as a, you know, together and kind of what your roles and responsibilities are, you know, between the two of you, and then do you have a family? Do you have kids? And what your kind of outlook is for real estate with having a family?
Yeah, no, great question. Try not to ramble too much. So Paul and I, we met at A&M. We were both students there. So that was 10 years ago. We got married 6 years ago. And pretty shortly after we got married, she informed me one day that we needed to find a hobby together. And anyone knows me, I work and then I run. Those are the only two things I do. I'm a runner. I enjoy it. But I don't really have a lot of other hobbies per se. And so I was like, what are we going to do? Like play golf, or I don't know. So anyways, one day I was reading a book pretty shortly thereafter, Rich Dad, Poor Dad. And so I got this idea like, hey, she's a finance major. She knows all about money. Like, what if we invested in like real estate, just bought a house and invested, and we can do that together? And, you know, she really loved the idea. It took off, and we just started learning and learning and learning. And we had such a great time listening to podcasts, reading books, talking about things, and eventually did our first, you know, project, which was a house hack, and then another one and another one. And so it's something we've done together from the beginning. We're both very type A personalities. You know, we will kind of walk all over each other, but we have a lot of fun doing it. And then when we started the multifamily, you know, we did it for about a year or so before I left my corporate job. And so then I've been heavily focused on that, you know, probably doing 80-90% of the work because it's my full-time job for the last year and a half. And then about a month ago, she also quit her full-time job. So now we, you know, no joke, work together full-time as syndication, doing syndications, and just investing in general. And so now we're kind of redefining what that looks like for us. And, you know, so I'm more the visionary of the company. I like to underwrite deals, come up with business plans, talk to partners, meet people. She's a little bit more of kind of our, you know, COO, our chief operating officer. So she's the asset management, the day-to-day, organizing stuff, keeping it clean, saying, hey, don't forget, like we got to do this, this, and this today. And so I think we complement each other really well in that sense. And by kind of keeping in those two swim lanes, we don't necessarily run over each other as much. So we pretty much have a very similar investing philosophy, very similar risk tolerance. So I'd say that all plays in really well. So I don't know. Some people, everyone asks that question, but we don't actually have a lot of problems with it. We don't have kids yet. When we do have kids, I would love to come up with a great story of what we're going to do, but honestly, I have no idea. So you'll just have to have me on the show a year after I have kids, and then I'll tell you.
Right. Awesome. Well, I've had husband-wife combos on the show plenty of times, and a number of them have said exactly what you said. They started out just all working together, doing everything, but then once they kind of figured out their lanes and then let each other work their lanes, they said that it helped them, both from a relationship and also from a business standpoint. So, well, you've accomplished a ton in a short period of time. Kind of what's next? Like, you said you're the visionary. Where do you go from here?
Yeah, so a lot of it is scaling. Just scaling units, but doing it the right way, which means buying deals that make sense. So we can continue to have a good reputation in our company. We're very fortunate right now that I have friends who they're great people, they're brilliant, but they bought a couple bad deals with bridge loans, and so most of their time and their focus is attending to those deals right now. And I'm very blessed I'm not in that position. All ours are long-term, fixed-rate debt. We're doing distributions on all our, they're going well. And so 100% of my focus is acquisitions. It's looking for deals that are distressed from management, that have renovation or, lender distress, and buying those deals over the next year and a half. And so that's where I'm focused. Paul is a little bit more on the capital raise side, making sure we have the investors to backfill those deals. And so it's really scaling the business, but doing it the right way. We're looking for a lot of deals here in DFW, which is, like you said, a very hard market to break into. And so we think this is a great time to really build a bigger reputation here in this city. And we're kind of at a point where we really like more B-class type deals. We're not into the older C-class. It just, that kind of stuff has not worked out for us near as well. And so, we like newer, nicer deals that work. So that's the direction we're heading. Awesome.
I've seen a lot of syndicators over the last, I say, 3 years start trading up from C class to B class and some even into the kind of A- area. So totally get it. Hey, if somebody wants to reach out to you and get to know you better, what's the best way for them to do that?
Yeah, absolutely. We have a website for our company, which is Apogee MFC, like multifamilycapital.com. We've got all kinds of information about us on there. I'm also extremely active on LinkedIn. And so if you want to send me a message there, I'll definitely respond too.
Great. Hey, can you spell
absolutely.
your entire website?
Sure. It's Apogee. So APOGEEMFC, like multifamilycapital.com.
Fantastic. Well, Jonathan, I appreciate you coming on. Listeners, I hope they enjoyed that one. Until next week, signing off.
Thanks for having me, Darin.
Thank you for watching Darin Batchelder's Real Estate Investing Show. If you liked the episode, please click the like button and subscribe to the show. If you already are subscribed, then thank you. And please share the show with a friend. Check out other free resources at darinbatchelder.com/learn.